York Stock Exchange, where we are in full rally mode today, Tyler.
We sure are. Hi, Kelly. I'm Tyler Matheson at CNBC headquarters in today for Bill Griffith, and this is not a boring mid-August day for the markets, not at all.
All right, let's take a look at markets right now. With an hour to go in the trading session, as mentioned, the Dow's trading in a strong performance, up 168 points or 1% now. It's actually the NASDAQ as well. They got an early start in the green, helping boost the risk complex higher. It's up about 38 points to 45.03. And the S&P 500, and this will be one to watch, it's at 1969 right now.
And what a great year that was. Joining our closing bell exchange, Rob Bartenstein from Washington Wealth Management, Stephen Hammers from Compass EMP Funds, Anthony Chan from Chase, and Winnie Sun from Sun Group Wealth Partners. Welcome one and all. Rob, let me start with you. We've gone a long way up. We've gone a long way down this summer. But basically, we're roughly where we began it, aren't we?
Very true. When I was here last, around June 18th, I think we were sitting right about 1955. And when I went to bed last night, I think we were right about the same level. Of course, it's a whole different story this morning as a result of some of the geopolitical risk getting moved to the back. But that's the market. That's true to form for the market over the last 10 years. Returns through the summer months have averaged a typical slightly negative return of about 0.3%. And up until this morning, we were running pretty true to form.
You should count Robert Shiller among those perhaps surprised by the stock market's resilience, Anthony Chan.
Absolutely. Last year, Robert Shiller was singing the same song, talking about the fact that the prices were overvalued in the stock market. But guess what, Kelly? If you would have listened, with all due respect to Professor Shiller, you would have missed out on the 29.6% rate of return on the S&P, the 2.2% dividends, over 30% rate of return. And by the way, you would have also missed out on the 6% plus
But by
this
the way,
year.
he's not saying that the overvaluation itself means the market's going to decline. He just says we're seeing persistent overvaluation. Yes. And should we be worried about that longer term?
No, yes, Kelly, but if people tell you that something is overvalued, you're going to be reluctant to buy it. And there's another issue that really cuts at the heart of this, and that is that he looks at the last 10 years worth of earnings. It is no secret that we went through the most ferocious financial crisis, and earnings were heavily depressed. So guess what? That price-earnings ratio that is computed is based on earnings that are way below average and way out of the box in terms of being too weak. So in my judgment, that PE ratio of 25 that he talks about this year is way too high, because earnings over the next several years are going to be much higher than they were in the last 10 years.
Winnie Sun, as Rob pointed out, we're basically where we were 2 months ago in terms of the major market averages, but we're just, I think, about less than 1% from an all-time high on the S&P 500. What's your thought about where the market may head next, and how can I make some money between now and the end of the year?
The main thing we want to do is we want to be positioned so we have the best opportunity to really make money in the market. So it's really time in the market. Stay true to your philosophy long term. We need to be patient. We need to give our portfolios time to grow. So the main thing is, don't worry about all the noise, but make sure that you're participating in the good and the bad. Remember, it's the day that you sell that matters, not the days up until that point.
And Steve, let me bring it back to this discussion we're having about whether the market's overvalued or not. Are you hearing the same concern by people reading Robert Shiller and looking at these valuations and saying this can't, is this unhealthy? Is this sustainable?
I think a PE of 25 is a pretty big stretch, especially within the next 12 months. But when you look at the market today, we might be a little bit on the high side. And I do believe the market's going to be trading sideways for quite some time, but there's a lot of room to grow. We're looking good. The economy's looking good. So there's definitely a lot of room for us, and it's definitely not high.
So when your clients in Nashville call and they say, here's my money, here's my inheritance, here's my life savings, etc., do something with it. What is it that you're doing with it right now?
Well, we continue to invest. We really focus on volatility weighting, which means spreading the risk across the entire market. And so the fund investors that we have that are all over the country, they're still buying at a very fast pace. So I don't think they see a lot of concerns, but we still have to be a little bit cautious, not necessarily put everything all at one time. But I don't think we have a lot to be concerned about right now.
Anthony Chan, the end of this week is all going to be about Janet in Jackson, i.e. Yellen in Jackson Hole. What do you expect to come out of that conference, and is there a way to position ahead of it, or is that kind of a fool's game?
No, I think there's a way to position. I think she's going to continue to talk about slack in the labor market. And guess what? There is a lot of slack in the labor market. When you look at part-time workers for economic reasons, which is one of Janet Yellen's favorite numbers to look at, that is 4.8% of the labor force. If you look at all the economic expansion since 1958, that has averaged about 3.7%, which means that we have close to 1.8 million worth of full-time equivalent workers out there. If you take that in the context of what average hourly earnings are and what the overall economy has the potential to do, that can add up to 0.8%, almost 1% to GDP without really boosting inflation. That is what the Federal Reserve wants to wait, and I think that they're right in waiting for that. And the last thing I will say about price-earnings ratios, that Schiller PE of 25 that was mentioned, yes, that's his number, but most people on Wall Street look at forward earnings, and that number is below 16, and the historical average is closer to 16.3 over the last 15 years. That's why I'm not so worried.
Let me just mention, as you can see on your screens there, President Obama is going to speak at 4 p.m. Eastern on Iraq and Ferguson, Missouri. We will take that when it happens. Rick Santelli, should these concerns, do you think about, especially what's happening in the Middle East, they've done nothing today to royal markets. Do you think that changes in the days ahead?
Well, from a humanitarian standpoint, of course, all these geopolitical hotspots, including the Middle East and Ukraine, should be something we all think about. From a market vantage point, as difficult as this may be to believe by many, I really think geopolitics is more of a weekend fear dynamic, an algorithmic, right words pop up dynamic, but I really don't think it's going to affect the TINA aspects, which is why equities keep playing on. You know, Mr. Schiller is a quant guy. This isn't a quant type market. We write off fundamentals at will. I think when you look at Europe, that's something to pay attention to. When there is an alternative, see, I don't know if we'll ever have a correction. We're going to either be loving stocks or hating stocks. And when that transition occurs, it's most likely going to be a forced transition, either for an exogenous shock that was unexpected, or there is an alternative to low interest rates. I think what you're going to learn in Jackson Hole is pretty easy. Janet Yellen will find some type of Rorschach example to keep doing the strategy she wants. Call it labor slack, call it whatever you want. There's 60 million Americans out there that aren't looking for work anymore. And as our one guest pointed out, in terms of historic slack, I don't buy it. You know, let's look at what the historic labor force participation rate was at those points and factor that in. The DAX had a nice bounce. The pressure's off for now. Interest rates moved back up. Remember, the average between 330 intraday low on Friday and the big close that was at, I'm sorry, 230 and 245. Yep. The average is right about where we're at 238. I look for this to be home base for several sessions.
Rick, let me just quote here from Schiller's piece where he hang on, guys, just for 1 second. Here's what Robert Schiller's saying. Nothing I've come up with is a slam dunk explanation for the continuing high level of valuations. I suspect the real answers lie largely in the realm of sociology and social psychology, which is exactly what you were saying, Rick. In other words, does the only thing that matter right now for investors then come down to fund flows and sentiment week in, week out?
Yes, absolutely, unequivocally, yes.
And sorry, the guest who is going to speak, go ahead, please.
Sure, Rick, it's Rob Bartenstein. I was just agreeing, I agree with everything you said. I was curious as to your opinion, though, as we look ahead into October with the Fed beginning to wind up the taper and go back to 2010 and 2011 when that happened. And clearly the market loves it. It's obvious the market loves it when the Fed's buying paper. But when they stop, we get these periods, 12-month periods of very difficult, very rocky pricing in equities, and also declines in the 10-year yield. So do you see that happening in October, starting in October?
You know, I think all the effects of the taper, in my opinion, are factored in the market. What's important is the ongoing holdings that the Federal Reserve will choose not to sell in the future unless they're driven to it through match sales and maybe a higher velocity of money. I think the next big game is zero interest rate policy under scrutiny and monitor the flatness of the yield curve to see the market's opinion on that.
Leave it there. Thank you, guys. Appreciate it. 50 minutes to go in the session. And as mentioned, it's been a relatively strong one.